So rules to remember. So a business normally deals with persons, whether natural, artificial, or representative. So when we deal with any person, then they are called personal accounts. So either we receive from them, or we pay, or the business will either receive or pay or give to the other business. So the rule is debit the account that receives or debit the receiver, debit the receiver. So some authors they write this way. So debit the account that receives or debit the receiver. Like David Hopkins and all, they use the first rule, that is debit the account that receives. They write it that way. So some other authors they write debit the receiver. Similarly, for credit items, they write credit the account that gives or credit the giver. So some authors write the one way or the other. So the rule is ultimately the same. I mean, the concept is ultimately the same. Real account debit what is being received. So in case of real account, when we receive or pay something, when a business receives or pays something, so then debit what is being received or debit what comes in. So credit what is being given away or credit what goes out. So this is the rule for real accounts. So you know what is real accounts. So when we deal with cash or bank or something like that. So nominal account, the rule is debit all expenses and losses, credit all incomes and gains. So nominal accounts are expenses and incomes, right? So accounting equation. So when we are recording accounting equation from the accounting point of view, when we see from accounting equation point of view, assets normally have debit balances, liabilities and capital normally have credit balances. So remember, assets and expenses normally are debit balances. Okay, so liabilities and incomes are normally credit balances. So even you should know, it is noteworthy that capital is also a liability. So it means capital, liabilities and incomes are normally credit balances.